The global financial system is flashing a red alert that most investors are completely ignoring. Right now, gold and silver are forming a pattern we haven't seen in decades. Signaling a massive price explosion is just days away. If you're holding precious metals or waiting on the sidelines, you are standing at a critical crossroads. Today, we're revealing the 5 specific warning signs that prove a historic move is imminent, and exactly how you can position yourself before the window of opportunity slams shut forever. For centuries, gold and silver have been the ultimate barometers of societal stability. When the world feels like it is spinning out of control, these metals act as the anchor. But something strange has been happening lately. Precious metals have been uncharacteristically volatile. While inflation remains sticky and geopolitical tensions reach a boiling point, their price action is puzzling. Many retail investors are being shaken out of their positions, convinced that the bull run is over. They see a red day on the charts and panic, thinking the experiment has failed. However, if you look beneath the surface of the charts and into the mechanics of the global economy, a different story emerges. We are not seeing a collapse. We are seeing a massive consolidation, a coiled spring gathering energy. This is before a generational breakout, a powerful move waiting to happen. To understand where we are going, we have to look at signals the mainstream media refuses to cover. The truth is hidden in data that big banks hope you don't analyze. The first major warning sign is the behavior of the world's most powerful financial institutions. While the average person is being told by financial news anchors that gold is a dead asset or a pet rock, central banks are buying it at the fastest pace in recorded history. Nations like China, India, and Turkey are dumping their U.S. Treasury holdings at an alarming rate and replacing them with physical bullion stored in their own vaults. This isn't just a coincidence or a minor portfolio adjustment. It is a strategic exit from the dollar-based system. We are witnessing the de-dollarization of the global economy in real time. When the very institutions that print the fiat currency start trading that paper for physical gold, they are telling you exactly what they think about the future value of their own money. This massive institutional floor is preventing a deeper crash and setting the stage for a supply squeeze that will catch the public completely off guard. When the music finally stops. While gold is the king of wealth preservation, silver is the workhorse of the modern world, and its story is even more explosive. The second warning sign is the widening chasm-like gap between silver supply and demand. We are currently in the 3rd consecutive year of a structural silver deficit. Think about the technology you use every day. From the solar panels on roofs to the intricate circuitry in electric vehicles and high-end electronics, the world's transition to a digital and green economy is physically impossible without silver. It is the most conductive metal on Earth. Yet mining production is stagnant, and in many cases declining because it is often a byproduct of other mining operations. We are seeing a massive drain on global inventories in London and New York once the physical market realizes there simply isn't enough metal to satisfy both investors and manufacturers. The price will no longer be dictated by paper contracts on Wall Street. It will be dictated by industrial desperation, leading to a vertical price move that could dwarf the gains in gold. If you look at the long-term charts, gold and silver are hitting what professional traders call a confluence of support. After the recent pullback that scared so many people, prices have landed exactly on the multi-year breakout lines. These lines date back to 2020. This is the moment of truth. Historically, when precious metals retest these levels during a period of high debt and low consumer confidence, the subsequent bounce is violent and sustained. We are seeing a classic shakeout, a psychological game where market makers drive prices just low enough to trigger stop losses. They force weak hands to sell to strong hands. The charts are screaming that the downside is limited by massive historical buying zones, while the upside potential is virtually uncapped because there is no overhead resistance. This is true once we clear the previous all-time highs. If the support holds here, and all signs suggest it will, the next leg up could take us to heights that previously seemed like science fiction. The fourth sign is the cold, hard mathematical reality of global debt. For the last 2 years, the Federal Reserve and other central banks have tried to suppress gold by raising interest rates, making the dollar appear more attractive. But they have hit a mathematical wall. The U.S. national debt is growing by $1 trillion roughly every 100 days. The cost of servicing this debt is now so high that it exceeds the entire defense budget. They cannot keep rates high forever without bankrupting the very government they serve. The system is breaking under the weight of its own interest payments. The moment the market senses a pivot, a pause, or even a hint of new liquidity being pumped into the system to prevent a banking collapse, the primary headwind for gold and silver will vanish. Real interest rates will turn deeply negative, and in that environment, precious metals have historically been the best performing assets on the planet. You don't want to be buying when the pivot is announced. You want to be positioned before it happens. The final and perhaps most telling sign isn't found on a chart, but in the streets. We are seeing a global breakdown in trust toward traditional institutions, commercial banks, and political systems. From the collapse of regional banks to the rising cost of living that is squeezing the middle class. People are waking up to the fact that their currency is losing its purchasing power every single day. History shows that when people lose faith in the system, they return to the only form of money that doesn't require a government's promise or a bank's solvency. Physical metal. This psychological shift is already beginning. We are seeing a surge in physical demand at the retail level, with premiums on coins and bars starting to rise again as people move their wealth outside of the digital banking grid. This is the fear trade starting to ignite, and once it goes mainstream, the window to buy at these prices will be gone forever. There's one more hidden signal that most people miss: the gold to silver ratio. Historically, this ratio tells us when one metal is drastically undervalued compared to the other. Currently, the ratio is stretched to levels that have historically preceded massive bull markets in silver. When gold moves, silver eventually follows, but it moves like gold on steroids. This ratio is a ticking time bomb for the shorts. As gold reaches for new highs, the pressure on silver to catch up becomes unbearable. For the savvy investor, this ratio is the ultimate map, showing that while gold protects your wealth, silver is currently positioned to build it at an exponential rate. We are looking at a rare alignment where both metals are fundamentally, technically, and sentimentally ready to explode simultaneously. The evidence is overwhelming. The fuse is lit, central banks are loaded, and a major economic move is coming. Protect your family's savings from a devaluing currency or capitalize on a historic market shift. The time to prepare is now, not after the headlines break. If this deep dive into precious metals was helpful, hit subscribe and turn on notifications. Don't miss critical updates as this situation unfolds. We want to hear from you. Are we betting on gold's stability or silver's explosive potential in the next 12 months? Let us know your price targets in the comments below. And if you want to see how the current economic collapse compares to the Great Depression, click the next video. Thanks for watching, and we will see you in the next one.